Today's topic is risk management while investing, and over to you, Atul, to take the discussion forward.
Thanks, Rajat. Hi, good morning, everyone. My name is Atal Agarwal, and as Rajat mentioned, I head the strategy function and investor relations at Lending Club. A just quick introduction about my background. I have been in the financial services for almost about 30 years, having spent the initial half of my career on the investment banking side. I worked with DSP Merrill Lynch, Barclays, and Kotak. I then moved on to the banking side with Citibank and RBS. Subsequently, I was heading the business development at Crystal Pan India, the ratings company, and currently with Lending Club. So I think what we're going to do is spend the next 20 minutes today discussing on a topic, risk management while investing, which is something that I think is a very important subject for any investor to keep in mind. So the question that comes into mind is why invest? Is there a reason to invest, or what is the logic behind investing? Clearly, any money that is lying with you idle is not earning any return. On the contrary, with the inflation which is happening, it will keep on eroding the value of your money, even if it is lying in the bank. So clearly, there is a need that we need to put that money to work. And hence, I would say some of the very common reasons why one should look at investing is, as I said, counter inflation, so that your value of the savings does not erode. Second is obviously the cost of living is going up, your cost of expenditure is also going up. So you need to create a wealth in your portfolio so that you are able to obviously have a better quality of life. There are certain investments which also offer you, in addition to returns, they also offer you tax saving avenues. For example, if you're putting money in some tax saving investments, it will give you some tax relief. It clearly creates an additional source of income. So while each of us could be either involved in setting up our own business, could be a salaried employee, could be a self-employed person, those obviously have one source of income. An investment will also create an additional source of income for all the investors. And clearly, as I said, when you have additional source of income, it also helps you to finance expenditure, which in most cases for all of us, the expenses keep on going up with each passing day. So clearly, there are very, very strong reasons why one should look at making an investment. Now, the point is we said risk management. The reason we say risk management is important is because when you make any investment, no investment is actually risk free. There is always an element of risk attached to it. And very rarely would you say that any investment is having 0% risk. So, clearly, what is risk management? Risk management really is the process or the method that you employ to maximize your returns or minimize your losses. In fact, if I want to put it another way, given that risk is always there, we are trying to maximize the probability of making money on investment and trying to minimize the probability of making a loss on investment. And that is what risk management is all about. I think before we actually get into the what are the various methods of risk management, how do we actually do a risk management? I think three very important steps. You need to identify what are the risks that are present in your investment portfolio. Once you identify the various risks, we can then start looking at evaluating those risks. That what is the extent of that risk in your portfolio? And once you've made an assessment of your risk, then you decide your strategy, which is trying to either eliminate the risk. As I said, there's no elimination of 100% risk. You're trying to minimize your risk, which means you put in place some risk mitigating measures. Having said what risk management is all about, I think let's go ahead. So now, given that we all of us are people from different walks of life, you could be a commerce student, you could be a chartered accountant, you could be an engineer, you could be a doctor, you could be a lawyer. Obviously, these are all different professions. I am not a finance professional, so how do I manage my risk? Well, you have two ways. The easier way is that you get and go to hire an expert who is a professional in risk management. But when you go to a professional, you obviously have to pay the price for that. And usually the fees that you end up paying for a professional risk management expert could be very high. So then what is the next alternative? The next alternative is that you yourself try to become an expert. Maybe not an expert like a professional, but an expert who can manage the risk of their own portfolio in a reasonably effective manner. So, how do we do that? How do we become an expert? What are some of the steps that we can take for risk management? So, I think the first thing that I would say for any investor, it does not matter whether you're a first time investor or you're a regular investor. A very important aspect, especially with a first time investor, is that you put in enough efforts on the research exercise. Because until unless you do a research, you will not be able to understand what, for example, are the various alternatives of investment, what are the various asset classes. How were the various asset classes impacted by developments in the market or government policies or government regulations, industry practices, price movements? We have to understand some of those things. For example, if you're putting money in, let's say, bonds, you would say, okay, fine. Which bond in the market is the safest bond? Which bond in the market gives me the highest returns? Which bond, for example, has got tenors of 1 year, 2 year, 5 year, 10 years, depending on your appetite? Similarly, for example, when you go to make a fixed deposit in a bank, you do some research, right? Which bank is paying the highest rate of interest for 6 month deposit, 1 year deposit? So, research is very important. Also, it will help you understand how do different asset classes work. So, the way an equity will work, vis-a-vis how a bond works, how, for example, a gold works, will be very different. So, you need to do some research to get an understanding, and then accordingly, you can then decide which investment class do I want to invest money in. So, research important. The second step that we should look at is, and this is especially true for first time investors, is to start small. The idea being that if you are a first time investor or a new investor, you are, I would say, in many ways, still very inexperienced. And hence, there is obviously a risk that maybe some investment decisions you make could maybe go wrong. So, the best is if you start with a small investment, then what happens is that the investment risk of a portfolio is also lower. You put in a large amount of money, and for whatever reason, the investment has a loss, it could be very difficult for you. But if you put a small amount of money, then the chances of you getting very severely impacted in case of a difficult situation is minimized. So let's say, for example, you may want to look at, let's say, a peer-to-peer lending, where the ticket size for investment is as low as 10,000 rupees. So the fact is, if you start with 10,000 rupees, you will understand how the process works. You will also be able to gain experience, and you will also be minimizing your risk. So I would suggest that you should not go for a very large amount initially, small amounts. I think there's a very popular saying that you should never put all your eggs in one basket, right? With the logic being that if the basket falls, all the eggs will get broken. Similarly, when you're making an investment portfolio, a portfolio means that you have multiple investments in your kitty. So when you're having multiple investments, it is important that you don't make all investments in one asset class. For example, let's say don't make all investments in the shares of only one company. Don't make investments only in bonds. Don't make investments only in insurance products. The idea is try to have different types of investments in your portfolio. So let's say if you have a 100 rupee money that you want to invest, let's say depending on your own risk appetite, you can put 20 rupees in, let's say, fixed deposits. You can put 20 rupees in bonds. You can put 15 rupees in gold. You can put 15 rupees, let's say, in equity stocks. You can put 20 rupees in mutual funds. Idea being, you're putting it in different types of products. You can put in 10 rupees in peer-to-peer lending. The more you diversify, the more the lesser is the risk in your portfolio. And the reason for that is very simple, because it is very rare that all investments will go bad at the same time. Number one. Number two, when there is any market news, any government regulations, any industry dynamics, each asset class reacts differently. So, for example, if you have, let's say, government announcing a policy of a regulation on a particular sector, now that sector may get impacted, but for example, other sectors will remain insulated. So you should actually try to diversify investments in your portfolio to manage your risk. I think a very important thing is, the fact is that there is obviously things keep on changing with time. What is present today may not be the same tomorrow. And hence, if you put all your money in, let's say, for example, today is 15th of September, 16th of September, if you put all your money today only in one investment and then do not make any investments for the next 10 years, then you will not be able to take the benefit of changes happening in the market over the next 10 years. But if you invest small amounts of money in, let's say, regular intervals, then you're also taking away the volatility in the market. Let's say today the market is, happily speaking, stock market is 68,000, Sensex is 68,000. Today, if you put money and do not invest money for the next 5 years or 3 years, let's say the market comes down tomorrow, you would have lost the opportunity to buy some shares cheap. Similarly, interest rates keep on changing in the market depending on the government policy. So if you make periodic investments, you will then have a portfolio which is much more balanced. And there is, for example, mutual funds follow this process of systemic investment plan. It's essentially saying invest regularly. I think no two people are the same. Your areas of interest, your risk appetite, your financial standing, your money that you have, idle money or surplus money, that will depend from person to person. Each person's financial condition, financial net worth, mental makeup is very different. I may be, for example, be able to withstand and take a lot of risk. Somebody else will be able to take that much risk. It is very important when you are making an investment portfolio to decide, how much risk appetite you have. If I put it simply, I would say risk appetite can be put in three ways. One is, what is the amount of money that I can invest? That will depend from person to person. Second is, what is the tenor for which I can make the investment? Third is, if things go wrong, what is the maximum amount of loss that I can take without impacting my day-to-day living, my day-to-day expenses? I need to make sure that these three questions I have answered in my mind. So let's say, for example, if let's say there are two people, it's me and Rajat. I have put in my money to buy, let's say, 10 shares in the market, and I've invested 1 lakh rupees. And the market goes on tomorrow by 30%, so I've lost 30,000 rupees. I'm left with my value at 70,000 rupees. Rajat has, on the other hand, borrowed 1 lakh rupees from the bank and invested in the market. Now, if Rajat also loses 30%, the fact is that he will still be paying interest on the amount he borrowed of 1 lakh rupees. So he may want to sell the shares quicker than me because he wants to reduce the interest cost that he's paying. Whereas I have put my own money, so I may have a better risk appetite. So it's important to make an assessment of your own risk appetite. I think it's very important that whatever things we have, we should keep on evaluating and re-looking at our portfolio on a regular basis, because nothing is constant. Things keep on changing. The country's economic growth, the country's GDP, the interest rate environment, the gold prices, the real estate prices, political scenario, everything keeps on changing. And these changes impact the investments in a portfolio in various matters. Let's say, for example, tomorrow the government decides to increase the capital gains tax, right? It could then impact equity shares in your portfolio. If the government decides to increase the interest rates, then your bond portfolio will get impacted, right? If, for example, the government puts additional stamp duty on property, your real estate investment will get impacted. It's important to keep on evaluating your portfolio and deciding how to rebalance. Sometimes it's important to sell something, buy something, increase the share. So you need to keep on revising and reviewing your portfolio. And I think a very important thing is to keep in mind that any investment, okay, it is very, very unusual to have any investment that can make you rich overnight. Until you have, for example, a very rich relative or a rich uncle, you will not be able to make money overnight. It is important that you have a long term horizon for investments. If you take short term decisions, then you will may end up making money, but the amount of money that you make if you stay invested for a longer period will be high. Usually, one has seen that most investments appreciate over time, and hence it is important to have a long term perspective. Number two, very important is, this is money which is involved. And when money is involved, it is always important to think with your head and not your heart, which means that you need to be taking very rational decisions and not emotional decisions. Because emotional decisions may not be in the best interest of your portfolio. So stay invested for long term and think rationally. I would say that those are some of the broad risk management tools which we as layman people are not professional risk management professionals, we can deploy to manage the investment in our portfolio. So maybe in summary, let's just revisit some of the points that I tried to cover in today's discussion. I would say top four takeaways. One is decide and do a diversification of your portfolio. Before building a portfolio and even after building a portfolio, keep on doing research and analysis on a regular basis. Decide what is your risk appetite. Do not copy other person's risk appetite or investment philosophy. Everyone's investment philosophy is different. And keep on monitoring your portfolio and keep on making adjustments as required. Some thoughts that I would like to leave with you is also the fact that any investment will give you a return, but clearly the higher the risk, higher the investment. Lower the risk, lower the return. So if you put your money, for example, in fixed deposit, the risks are much lower. Fixed deposit with the bank, risks are much lower. Then the returns are also 6 to 7%. You put your money in a market instrument like a mutual fund, returns could be like between 8 to 12%, but there is an element of market risk. So there is always a balance between risk and return. And managing a risk is not a one-time exercise. It is an ongoing process to do it continuously on a regular basis. I would say these are some of the things that you should possibly keep in mind. If obviously you are looking at getting into much more sophisticated investment products, then maybe you may need the help of a risk management professional. Otherwise, I think all of us can manage our portfolio ourselves if you follow some of these techniques. I think clearly, as they say, it is always best to keep things simple and think of the basics. Once you address that, you would have possibly made most of the decisions that is important. Thank you. And we can then now take questions.
Awesome. Thank you so much, Atul. Yes, so if you guys have any questions, we have some time left. Please feel free to drop it in the Q&A box. We do have a couple of questions that I'd like to ask you. One is how you personally, which asset classes do you invest in and how do you diversify?
Okay. I think it's when you're making an investment, I would always suggest, as I said in my talk earlier, I would have a diversified investment portfolio. In my portfolio, I have fixed deposits with the banks. I have P2P lending with some of the P2P lending company like Lending Club Raja, because it gives me good returns. I have some stock market investments. I have some mutual funds, and I have one property. But more importantly, I also have some cash in the bank, which will help me at least cover my expenses for the next 6 months if I lose my job and don't have an income coming in. Because a lot of time investments are locked in for a certain period of time. But I would need to have some liquid money to run my house in case any emergency arises or any medical emergency.
Okay. One more question is how does an investor handle geopolitical risks?
So, well, it's a good question, Rajat, and it is something which is not very well understood from a financial investment point of view by most investors. I would say one of the things that one of the things that I follow personally is I try to keep most of my investments into, let's say, three kind of products. One is that I have a certain limit on the investments that I make in companies which are government owned, because government policies can impact that. Also, certain sectors are more dependent on the government. So, any sectors which are dependent on government regulations, I would have a certain limit. Number two, I would also put my most of my money in domestic markets because I don't understand how things pan out in other geographies. So I would be reluctant to put a lot of money in overseas investments. Number two. Number three is I will keep on doing a lot of research to read how things are happening in the global environment. So, for example, when we're talking of today the Russia-Ukraine conflict, it is very clear that because of the conflict, the oil prices will be volatile. So maybe at that point of time, I'm going to invest in certain oil companies because I don't understand that.
Correct. Okay, I think we can stop presenting. One more question is, do you suggest any mix of short-term and long-term investment? You went through the presentation and you mentioned that investment and wealth creation is a long-term thing. But is there anything that's short-term that an investor should explore? If yes, how do you define short-term?
Okay. So I think it is important that when I'm talking diversify my portfolio, diversification not only in terms of different asset classes, I would, for example, put money in fixed deposits, put money in a P2P lending product, put money in, let's say, an equity share mutual fund. But at the same time, I would also put money for different tenors. So let's say I will put money in a, let's say, 6 month deposit. I will put money in a 1 year P2P lending products. I will put a 3 year money in bonds, and I'll put possibly 5 year money in mutual funds, and I'll put 1 year money in equity. So I would put my money in different tenors, and I'll put money in different asset classes. And the reason for that is very simple. If I can take 1 more minute, Rajat,
Yes.
is that in an FD, I'll possibly get about 6 to 7% return. In a debt mutual fund, I'll get a return of between 7 to 9%, right? In a P2P lending, I can get a return between 10 to 12%, right? So what is happening? I am getting returns of uh, different returns for different asset classes, and hence my portfolio can have an overall return of, let's say, 10%.
Got it. Perfect. One last question I think we can take is there are a lot of robo advisory platforms that has come up recently, which kind of promises that they can mitigate your risk by diversifying across various asset classes, and when there are ups and downs, they can also handle that. What's your personal opinion about it?
I would say robo advisory services would be more appropriate for very sophisticated investors. where you are talking of making investments which are very, very time sensitive, right? Or very, very complicated. So, for example, if I'm putting money in derivative instruments, futures and options, right? Those are complicated instruments. And there, a robo advisory firm, those services will be valuable to me. But if I'm making a simple investment, let's say in a P2P lending or a simple investment in equity markets, I think the importance of robo advisory for most of common investors would be limited and not worth the fees that you'll end up paying. Typically, most institutional investors use robo advisory firms or large brokerage houses.
Got it. Okay, one last question. I think it just came in. Do you invest in P2P through Lending Club? If yes, how do you make the decision of choosing Lending Club for your investments?
So that's an easy question to answer. I work for Lending Club, so yes, I do invest in Lending Club. But even before that, the reason I invest in Lending Club is also a function of, as I said earlier, my research. So when I make an investment, I do a lot of research. There are multiple P2P platforms in the market. What I realized from my research was that Lending Club is India's largest P2P lending platform, and historically they have given very good returns of over 10% per annum. To get a return between 10 to 12% on a fixed income instrument is, as an investor, I think very good. So yes, I have invested in Lending Club's P2P platform, and I put money in 2 or 3 tenors. I put my money for 1 year, for 2 years, and for 3 years. I'm still thinking of making investment in 5 years.
We'll definitely love you to do that. All right, great, Adel. Thank you so much for your time. It was a great conversation. We had some amazing questions as well that we could address within time. If any one of you want to, read more about risk management, we have a blog written by Atul as well, which we will share with you all over an email. And yeah, and thank you so much for joining.
Thank you, Rajat, and thank you for all the participants to this call. I know it's a Saturday morning, so thank you for joining. Much appreciated. Have a lovely day.
Thank you, guys. See you next time.